Investing can be a complicated process, but one of the most significant challenges is not related to financial markets or investment vehicles, but rather to our emotions and behaviors. Our emotions and behaviors can affect our investment decisions, leading us to make mistakes and miss potential opportunities. This article discusses how emotions and behaviors impact investment decisions and provides tips for avoiding common biases. The impact of emotions on investment decisions. Emotions play a significant role in investment decisions. For example, fear and greed can drive us to make impulsive decisions that we later regret. Fear can cause us to sell investments at a loss, even if the fundamentals of the investment are still strong. Similarly, greed can cause us to invest in risky or overvalued investments, hoping to make quick profits. The impact of behaviors on investment decisions. Behaviors also affect investment decisions. For instance, we may chase after past performance or invest in familiar companies, regardless of their future potential. We may also ignore or downplay risks or become overly confident in our investment decisions. Strategies for avoiding behavioral biases. When investing, to avoid common behavioral biases. When investing, consider the following tips. Create a detailed investment plan. Develop a clear investment plan that aligns with your long-term financial goals. The plan should include your investment objectives, risk tolerance, investment time frame, and asset allocation. With a well-defined investment plan, you are less likely to make impulsive decisions based on emotions or behavioral biases. Follow your investment plan. Once you have a solid investment plan, it is important to stick to it. Avoid the temptation to make impulsive decisions, even if the market is volatile or there is a popular investment opportunity. Following your plan can help you avoid common behavioral biases, such as chasing after past performance. Diversify your portfolio. Diversification is an important strategy for reducing investment risk. By investing in a variety of asset classes, sectors, and geographical regions, you can reduce the impact of any potential losses. A diversified portfolio can also help you avoid putting too much money in one investment. Stay informed and educated. To make informed investment decisions, it is important to stay up to date on market trends, economic indicators, and news related to the companies you invest in. By staying informed, you can avoid being influenced by emotions or behavioral biases. It is also important to continue educating yourself about investing and financial planning. Seek professional advice. Consider seeking the advice of a financial advisor or investing expert. They can offer objective advice and help you avoid common behavioral biases when investing. A professional advisor can also help you develop a personalized investment plan that aligns with your financial goals and risk tolerance. Conclusion. Investing can be a complex process, but one of the most significant challenges is often our own emotions and behaviors. Understanding how emotions and behaviors can impact investment decisions and following the tips outlined above can help you avoid common biases and make informed investment decisions that align with your long-term goals. We hope you find this video useful. Subscribe us for more investment videos.